Sell America. That's the narrative that's creeping into the markets right now. And we're going to talk about whether that's happening and what the implications could be as well. Today, we're going to be taking a look at the Thackray's February 2026 newsletter in video format. So I'm going to go over my newsletter, a little more detail. Some things I'll skip over a little bit, but I'll try and add as a supplement to the newsletter. So I think you should read the newsletter as well as watch this video. Try and keep it quick. I tend to be a little bit on the long side. I'll try and keep it a little bit shorter. We'll take a look at what's driving the markets right now. We'll take a look at the sector performance from a seasonal perspective, and I've got some insight in the small cap sector here, a little more detailed information, and we'll also take a look at a couple of rants at the end as well. So let's start off by taking a look at what's happening in the markets from the Sell America perspective. So this is the narrative that's creeping into the markets right now, and I want to say that it's really, really important that investors separate out their political beliefs and their emotions to what is happening, not what they want to happen. You may like Trump or not like Trump. You may like Carney or not like Carney or whatever it is. You have to take a look and see what is happening in order to make the investment allocations properly. And a lot of investors have trouble with that. But what is happening right now? Well, if you take a look at what's happening in Europe, here's on Monday, they're an extremely large fund manager in Europe, $2.4 trillion. They publicly disclosed that they're pulling back on U.S. investments in 2026 because of the uncertain climate. It doesn't matter if they're right or wrong. That's just what they're doing. And they're not the only ones. So this could actually spell a little bit of trouble for the markets just because it's happening. Now, if we go back to the spring of 2025, heading into April, we can see that here's the S&P 500. Yes, here it went, and it went down, of course. Here's Europe as an example. It went down as well. But take a look at the relative performance into April. You can see that Europe outperformed the S&P 500 in the first few months of 2025 because we saw this sell-off narrative that was taking place. So we saw yields on U.S. Treasuries head higher, U.S. dollar head lower, and the stock market underperformed. That's the trifecta of, well, not very good. And that's because investors were selling America at the time. They said, well, we're not sure what's going on. And so we just want to re-domicile our money. And so they're pulling back. So ironically, the U.S. economy tended to actually be quite strong. And in 2025, much stronger than any of the European countries. And if we take a look here, that could be the case today as well. But that may not matter because you have to take a look at relative valuation. So if we use something like the PE ratio here, which is a very simple metric, of course, and there's different ratios we can take a look at, but just for the purposes of this discussion, here's the S&P 500 in red. Here's Europe, a PE ratio here. You can see it is much lower. So what happens in a time of uncertainty and when investors are rotating out of growth, which is what is happening in the markets right now. We're going to get into that in a minute. Well, they tend to go into value and they tend to go into markets with lower PE ratios, and that would be Europe. Now, Europe, the economies are basket cases in a lot of cases, and the U.S. economy is strong, but that doesn't matter. In the short term, yes, in the long term, you have to have a stronger economy. But in the short term, investors are going to move their markets for other reasons. And that's exactly what's taking place. It's really a rest of world outside the U.S. Now, can this continue? Yes, it can. If you take a look at European countries, how much they hold 40% of the U.S. Treasuries. That's just European countries. But Japan could also end up selling treasuries as well. It's a little bit of their piggy bank because they are in trouble here. And they're going to be spending a lot of money. So we could actually see Japan actually sell some of the U.S. treasuries that they have, and Europe actually has a lot as well. So the selling could continue. So it may not be over. And really what I want to take a look at here is the equities. And this is what investors are really focusing on. Here's $6 trillion of equities, U.S. equities held by the EU. $6 trillion, because EU investors can't really get the technology sector that they can in the U.S. in Europe. They can't. NVIDIA or Microsoft or Google, it just doesn't exist. So if they want that exposure, they actually have to go to the U.S. Well, they've got a large position here, and guess what's happening? A lot of those stocks are underperforming, and investors are selling the U.S. So when they sell the technology sector, what do you think foreign investors do? They convert the currency back to their own currency and re-domicile their funds. And that's exactly what we saw in the spring of 2025, and that's a risk that we actually take a look at now because we are seeing the technology sector underperform. So I think it's something we have to watch out for. I think you can get caught up in, yes, the U.S. economy is fantastic and it's outperforming everybody else and it's doing great things or whatever it is, but you have to take a look at other factors. That's why we're seeing the emerging markets, we're seeing Europe outperform, we're seeing various countries outperform. So it's not the U.S. at this point. And partly because if you take a look at the composition of the U.S. market, it's about 33%, 34% of technology in the S&P 500 on a cap-weighted basis. And if you start throwing communications in there as well, you get about 44% of the market. If that's underperforming, investors are going to be going elsewhere. We've actually been in a market of wide doors, and we're moving to a market of narrow doors. So what do I mean by that? Well, this wide door, this is what's happening. The technology sectors, if you take a look at something like technology or communications, these companies are huge. So money's moving back and forth, sloshing around in the Mag 7, et cetera. It doesn't really move the markets that much just because the cap weighting is just so big. But what we're seeing is we're seeing a shift out of the growth sectors of the market and moving into other markets, such as small cap sector, commodities, international markets, emerging markets. These are much smaller markets. So when the money flows in, they can really create a huge upside. And when it flows out, they can obviously create a huge downside as well. So expect to see increased volatility in these sectors. And we could also see some large upside as well if this continues. Just something to watch out for. If we take a look at the different sectors of the market right now, so let's take a look at the growth sectors for the S&P 500. So right now in green is the communication sector. It's actually holding up relatively well compared to the S&P 500. So all these lines are relative to the S&P 500. The red here is XLY, so we're seeing consumer discretionary sector underperform the S&P 500, so it's putting downward pressure on it. And here's the technology sector at the bottom here. And look at this, it's actually been heading lower since October, and we keep seeing that get hit hard. So money's been flowing out of the technology sector and the consumer discretionary sector. Where's it been going? Look at this down here. Here's some of the cyclicals in the red and the green. So we're looking at the green. This is the energy sector. Boom, it's going up a huge amount. Red, we're looking at the materials sector. We're also taking a look at industrials going up. So the one sector that hasn't been performing well in here has been the financials. And that has not been doing well. But the other cyclicals have been doing extremely well. That's because the money's rotating into those sectors, and where the U.S. economy still is quite strong. So in the U.S. economy, you might be saying, well, yeah, money's flowing out and going to other markets, but in the U.S. economy, it's also flowing, or U.S. markets, it's also flowing into certain sectors. And so it's been the cyclicals. But there's been a recent development, and we'll take a look at this a little bit later. Here is the defensive sectors right here. And so if we take a look, once again, these are all relative to the S&P 500. We can see that we're starting to see all of these sectors head higher. Now, I want to point out, here's the utility sector. It's been consolidating relative to the S&P 500 on Friday. We saw that actually break out here a little bit here, so that's a positive breakout. Consumer staples has been on fire for no reason. And why? What's going on? Nothing really, except for investors want to leave the growth sectors and they still want to stay invested in the markets. And so they've been pouring into the defensive sectors, which means that, well, yeah, investors are going to have to watch out, because that means over time the market can get hollowed out. And that's something we have to watch out for. It's good that the defensive sectors are outperforming to help the averages, but underneath we're seeing some signs of trouble. If we take a look at what's happening with the U.S. dollar, and I think this is a real key one here, you have to take, if you get the U.S. dollar right, you're really helping the overall picture, because it really drives a lot of what's going on. And I talked about this right now, or over the last while. So here's U.S. dollar, here's the Dixie basically. So here's 100 here, which is where we've been in this trading range going up and down. And well, here, take a look at 2025 when it was the Sell America. Look at the U.S. dollar got absolutely crushed in 2025 when the Sell America trade was going on. And we've seen it consolidate since, and we've seen it break down here, head below 97, which has really been the support level. And if it continues lower, that could, once again, investors overseas may say, well, you know what? I don't like this. I'm going to start pulling my money back. I'm going to go into emerging markets and other markets around the world, because I don't want to lose on the currency and the markets at the same time. And that could be a little bit of what we're seeing right now. And if we see the dollar head even lower, that could actually be a big factor. Now, Trump and Bissett have come out numerous times and said they want a lower U.S. dollar. Now, they'll jawbone it so it doesn't happen fast. But they either have to give up the bond market a little bit or the dollar. And they've said, well, they're okay with a lower U.S. dollar. So I would not be surprised to see the U.S. dollar head lower. And that has huge implications. So investors need to be looking outside of the U.S. if that does take place into other markets. So let's take a look at some of these sector opportunities here. Here's some seasonal opportunities. I want to take a look a little bit more in depth at small caps. I got a request for this. And because the small caps have actually been a beneficiary of that rotation that's taking place out of the growth sectors. One of the areas that the money's been going into is small caps recently. Now, if we take a look at small caps over the last, a few years, we've seen small caps. Let's just jump ahead to this graph here. You can see that small caps have been underperforming, in this case, the S&P 500. And that's been happening year after year after year. But in a strong seasonal period, small caps have actually done quite well from mid-December, sometimes earlier, into early to mid-March, typically early March. And if we take a look at this graph here, we can see that recently we've seen this pickup for the small cap sector starting before this strong seasonal period. Sometimes you can see that pickup starting to happen in October. And that's exactly when we saw the growth sector start to underperform, late October. So we've seen small cap sector actually benefit from that. Now, in this case, this bottom panel here, I'm comparing it to the RSP. So that's an equally weighted S&P 500 ETF. And we can see that really since April, the small cap sectors have been doing quite well here. But let's take a look at some of the drivers you have to watch out for small caps, and we'll take a look at the seasonality here. So some of the drivers are the US dollar moving lower. Now, with small caps, they tend to do better if the US dollar is moving higher. Why? With a higher US dollar, that means a lower import cost for goods. And we've got the tariffs, don't forget. But lower cost for importing goods. And on top of that, with a higher dollar, the small caps really don't export a lot. It's the large caps that do. So we've seen with a falling dollar, small caps outperforming. So this is the relative graph. We've seen small caps outperforming. So once again, falling dollar is actually the small caps have actually done quite well here. So that's really showing the small caps have some strength here. I want to go down here and also take a look at the Treasury market. So here I'm using the U.S. 10-year Treasury note. And you can see here that the Treasury yield has been increasing and small caps have been outperforming. That's also a sign of strength for the small caps because typically higher yields mean underperformance for the small caps relative to the S&P 500. Why? Because they have higher financing costs than the S&P 500. If you go back to COVID, you had Apple locking in these long bonds and et cetera at really, really low rates. Small caps don't have that same opportunity. They tend to have much shorter duration and they have to roll over their debt. So you find that rising yields tends to hurt small caps, but it hasn't because we've seen this strength for small caps. So once again, that's been a positive. So small caps have been good. Lots of strength. But let's take a look at some of the seasonality. And this is relative to the S&P 500 here. And we can see here, and you may look at it, this is average over time. And you can see, well, it goes up and it goes down. And well, let's take a look at some of the months and we can take a look at the averages and the median. Well, we can definitely say that August and September tend to be weak for the small cap sector. And we want to take a look comparison to the S&P 500. And so it's hard to really discern a strong trend in here. And here's the frequency of a positive performance. And if we go down here, though, and we start to take a look at the positive performance relative to the S&P 500, we start to see some weakness starting to develop in March. And so this is the key metric because you start to blur in the medians and the averages, and you have to take a look at the frequencies as well. But we do start to see this underperformance, particularly if we start to see the market roll over, and that's a risk for the market. And then we have April as well for underperformance for the S&P for the small caps. So that's why I say that the small cap sector actually ends its strong seasonal period in March. Sure, yes, on an absolute basis, it can go on. But you really have to be careful with small caps starting in early March. So let's go back and take a look here. This is the IWM, so Russell 2000 small caps, and this is relative to the S&P 500. So I've put a red line here. So we're only going to look at the exit points for the seasonal period, so early March. That's all this. That's what these red lines represent. Is the early March. If we take a look relative to the S&P 500, we're not going to do the absolute, but you can go back up and take a look. You can see here over the last number of years, in March, we've tended to see the Russell 2000 underperform in the following months and heading into October. So in 2014, 2015, now that didn't happen in 2016, so you are going to see some aberrations with interest rates extremely low. Then we did see it once again in 2017. And 2018, it's sort of a little bit here going to October. It's questionable. It's kind of close. But if we go off to 2019, the small caps underperformed. 2020 underperformed as well. Although after that was the COVID as well. We did see small caps actually pop up into the next end of the strong seasonal period in March and then roll over again. So here we saw the underperformance again starting in March, then under again. So you're getting the picture here that yes, Small caps have benefited from outperformance relative to the S&P 500 because of that rotation from growth. But we are coming up to an inflection point in early March, and we do see the markets weaker. The small cap sector could actually underperform as well. So just like a rising tide lifts all boats, small caps have been going up with everything else that is not the large cap U.S. basically. And so that's been making the small caps appear stronger than what they might actually be otherwise. So I guess in the end, the note is that you have to be a little bit cautious starting very shortly, particularly if we see a negative market. And it tends to be a pattern of underperformance for the small caps starting in early March. Okay, so let's move on to uranium. Look, uranium is a really strong sector. We're still in this uptrend right now on an absolute basis. The fundamentals just don't change day to day. We just keep getting more and more positive announcements, no negative announcements, and yet it's extremely volatile at this time. And so if we see a market sell-off, and this goes for the other commodities as well, if we see a big risk-off move in the markets, we're probably going to see sectors such as uranium, metals and mining head lower and more than the markets, even though the fundamentals haven't changed. We're short copper, we don't have enough copper, we don't have enough uranium, all of that stuff doesn't change, but the narrative is what drives the markets. We're still in this, the trend is still intact here. We have to watch it if it breaks below here, but we might see this extend out another couple months if we do not see the market actually start to fall apart here. Metals and mining, so we're using XME in the States. We saw this uptrend here, performance relative to the S&P 500. We saw it break down, pick up again. We're on this trend line right now. It doesn't include Friday here. I'm doing this video Friday evening. But if we take a look here, we might actually be breaking down here a little bit. So if we do see a risk-off move, this sector will probably underperform. Just it's gone up so much and relative to the S&P 500 as well. But I still expect otherwise. I still expect it to outperform perhaps into mid-April. If we take a look at industrials, now here's the industrial sector. Really what's going on here with the industrial sector? It's just been a beneficiary of the rotation out of the growth sectors. Look at this performance. So here on a technical basis, we saw this consolidation going across, and then we saw that breakout. Look what's happening relative to the S&P 500. We're in the strong seasonal period for the sector. I get it. But the sector is overbought here a little bit. Hasn't turned down yet, but we could see it. I wouldn't be surprised. Materials, not very different here. Here's this resistance line right here. And boom, right at the beginning of the year, we saw this strong outperformance. Once again, growth into cyclicals, and we saw that outperformance here relative to the S&P 500. Financials, if we take a look, absolute basis, consolidation, and we saw the strong underperformance for most of the year in 2026, or 2025, I should say. We're just bouncing around here. There's nothing really positive about this sector at this time. We'll have to see if it can sort itself out, but we could possibly see it break down. Here's the energy sector. Once again, we've seen these really key resistance points going all the way across here. And it's just like what we saw back here with the material sector as well. So here's a key line of resistance. Look what happened when that line was broken. It's been going straight up. It's kind of weird how strong this trend has been. And I believe it's because people have been using the energy sector as a proxy for the commodity sector. We've seen that spillover really go into the energy sector. We haven't even started the strong seasonal period for the energy sector. It starts on February 25th. We tend to see more volatility in January and sometimes in early February. We haven't seen that. We've seen the energy sector do well. Yeah. There's talk of a possible war between the U.S. and Iran, and it's getting a little bit messy. We'll have to see what happens as far as that goes, but it might be a little bit of premium in there. So if it doesn't happen, which would be a good thing, we could see the energy sector pull back. But once again, we're still in that stronger seasonal period for the energy sector. Okay, let's talk gold. Gold here, we did see that January 30th pullback here, and just an absolute boom, pullback, big time. So day after day, we saw gold ticking higher and higher and higher, week after week, all these green bars, and then boom, it got hit on the last day of January. It's going to happen at some point. I was surprised at the depth of what happened. The fundamentals haven't changed for gold. We still see huge central bank buying. China has been buying gold, they just announced, for the last 15 months in a row. So the buying there, it's just some of the market equilibriums between the East and the West is exasperating the situation a little bit, providing some of the volatility. So we did see that pull back. Now, this was back to the trend line. And this was before Friday, So it may be pull back here a little bit. We want to see if that continues down a little bit for a couple of days to see if that is the case, and that might be a little bit concerning. But if we take a look here, we do look at the RSI, so price momentum. It has pulled back to this 50 line. So when we're in a bull market, we tend to see bounces off the 50 line, just like we saw back all in these instances here. So we could see the same thing happen here. We'll have to see how that plays out. But we're still in a strong seasonal period for gold. We could see it move higher, but it is starting to get volatile. And I think we're probably looking at this cap here between these two levels from here, where we're going to probably trade in the trading range for a while and consolidate. And if we break one of those, on the upside, that would be positive news. Downside, we might see some more consolidation as well. But I think right now we're still in that consolidation range. Silver as well. January 30th had that big hit. Whoa, what a hit. Down 28.5% in a day. And that had a lot to do with traders and contracts, etc. But we're still in that RSI possible bounce. And we saw on Friday, we did see it get hit again. So we're coming into the Chinese New Year. So we're not going to see the demand from the Chinese, which has really been holding up the markets. So we've been seeing in the West, there's lots of stories about people taking in their silver coins and trying to sell the silver coins. And they're getting below spot and quite a bit below spot because so much silver is coming in. However, in the East, that's a different situation. They're trying to get the silver. So there's bottlenecks and flows and whatnot. So we might see some more volatility coming up as we move into Chinese New Year. Gold miners, we're seeing the same phenomenon take place. Trend still intact, at least up until Friday. We'll have to see what happens to see if we do see this come down for a couple more days, which is possible. We really haven't seen any breakdowns, as I've said in the past. We've seen consolidations higher and then consolidation and higher. So we haven't seen that pattern break yet. I want to talk about the Canadian US dollar. Now, there's been three factors that have been driving the Canadian dollar higher. When you get these three factors, if you get these three factors working in all at once, the Canadian dollar tends to move higher. So let's go through the three factors. First of all, a falling US dollar relative to the world currency. We saw that earlier with the Dixie. We've seen that sliding relative to world currencies, and that's a big one. Rising oil prices, and we'll take a look at these in a second. I got a graph on the next page, and I'll have that in the red line. The purple line is the world currencies. And the last one is the 2-year differential spread between the Government of Canada bond and the U.S. Treasury 2-year, and we've seen the spread moving higher, which favors the Canadian dollar. So all three of these things have been favoring the Canadian dollar. So let's take a look here. So we take a look at in blue, first of all, this is what's happening with the Canadian dollar. We can see it moving up higher. In gold, this is the differential between the 2-year yields, and it's been moving higher. And in red here, this line here, this is the price of oil, and it's been moving higher. So these are all moving higher. And here we can see the US dollar moving lower relative to world currencies. So that's really why the Canadian dollar has been doing well. If these three factors change a little bit, things may change, but right now we are seeing some downward pressure on the U.S. dollar. And the good news is the strong seasonal period for the Canadian dollar starts very shortly. It's starting in mid-March, CAD versus USD. And the strongest month of the year on a seasonal basis for the Canadian dollar is April. So we are coming up to the period where the Canadian dollar can do well. We'll have to see what happens. Okay, I wanted to put in the graph of the technology sector here, and I talk a little bit about what's going on. We saw that announcement with Claude AI, through Anthropic, and that's really, wow. Okay, it's been really driving what's happening in the markets. We saw recently Anthropic announced that they come in with new AI tools, and that's all anybody said. But I've actually looked at some of this stuff. I'm actually going to try and use this stuff as well. I play around a little bit with AI, but some of the claims are just huge. And so the new tools, we saw companies like Thomson Reuters sell off by 15%. Okay, now in the short term, I think you may be overdoing that because you have to layer in all the technology, etc. But it is kind of scary. Then we saw AI. The effects of the AI and Claude AI really spread into other parts of the market. It's just going through different sectors of the market as they release earnings, and those sectors are getting crushed as well. There's actually a meme out there. I probably should have had it up here, but of AI with a Grim Reaper just going through and just knocking on each door of different sectors and just slaughtering those sectors. So a little bit of what's going on in the market. But I do want to show you here with technology here what's happening with this rotation. So this is relative to the S&P 500. You can see here we have seen this underperformance for the technology sector. A lot of people are saying, oh, it's a broadening of the market. sorry, I'm not sure if I'd actually classify it as a broadening of the market. I'd call it more of a rotation. So it's not like the technology sector is heading higher. Take a look at Microsoft and some of these other stocks. It's just unbelievable. So we're seeing it head lower, which means a rotation. Another growth sector is the consumer discretionary sector. We have seen it consolidating here, going all the way across. It looks like it's breaking here a little bit lower here. We'll have to see if it can get some traction as well. Here's the retail sector. If we take a look using XRT, once again, that we're seeing a consolidation just like what we're seeing with the consumer discretionary sector. Here's Canadian banks. Okay, this has been absolutely incredible. Right spot, right place, right time, and a huge part of the Canadian market. And I know a lot of people own banks, so we've seen the Canadian banks do extremely well. We did see them start to pull back here in late December here relative to the TSX here. And we have seen the price momentum sort of decline a little bit, but you know what? Honestly, they've still maintained their trend upwards, which has been good. Now, I do want to say the Canadian banks actually start to release their earnings in the last week of February. We'll have to see how they do. They may be attractive because of their high dividends, etc. But usually if we see this strong of a performance for this long of a time, we need to see some strong reports to really drive that sector higher. We'll have to see what happens there. Okay, here's a consumer staple sector. This is nuts. Look at this. I mean, this is like Skyrocket or CN Tower or whatever you want to call it. Absolutely crazy. We saw all these resistance lines again, but look at this. So why did it go up? Well, there is no reason. Absolutely no reason. So you've got the PE ratio for this sector at 21. This is a low growth sector, defensive sector. 21 times forward earnings. So it's expensive for low growth. So what happened? This is investors going from growth to defensive and saying, we still want to be in the market. We don't want to get out. And they're piling into consumer staples. Now, word of warning here, the consumer staple sector can actually do well in the month of February if the market's having some trouble. And that's exactly what we're seeing at this point. So what's the opportunity for this in March? Well, if we take a look at the utility sector, well, look at this. We've seen this consolidation happen here and a little bit of an uptick here. And this is a breakout for consolidation, which is really good. And relative to the S&P 500, we're seeing the same factor take place. And guess what? On a seasonal basis, the utility sector can perform well in March when the market's having a little bit of trouble. So this could be an attractive sector, at least in the short term on a seasonal basis, as far as decreasing beta in a portfolio. Okay, so let's take a look at the rants. Okay, so I got a few rants here. The first one is my favorite topic, California, one of the worst run states in the U.S., if not the worst. This is a battle between a few states. Love California, love the people. It's just very, very poorly run. They're considering a 5% wealth tax, and they call it the billionaire tax. It's only going to be one time, 5%, and it only affects the wealthy people. Look, everybody knows that it's not one time. It'll be twice. There's no tax that's ever temporary. There's no such thing as a temporary tax. It'll be twice. It'll be 3 times. And it'll start going down to the main masses as well. In fact, we just saw the Netherlands now propose and approve a 36% wealth tax on capital gains, unrealized. So this is coming. And so what we're seeing is billionaires like Zuckerberg here going, well, you know what? I'm not part of this. And I pay a lot of tax, but so I'm going to move on. But here's the thing. The billionaires have the advantage here. So why did I say that? Well, Zuckerberg, he's got his house right now. His main house is in Palo Alto, California. Right? That's his main residence. But he also, in Hawaii, has a compound of multiple houses and a doomsday bunker as well. Got a lot of grief over that one. He's got 2 houses in Lake Tahoe. He's got 1 house in Washington, D.C., and he's buying a house, and I think it's confirmed at this point, for $200 million in Miami, Florida, on Indian Island, billionaire's bunker they call it. And he also has a 387-foot yacht, a fairly new yacht that consumes as much power as a small town. So it's not a house, but it could be. So he has all these choices. So what does he have to do? He just fills out a form and says, oh, guess what? Miami, Florida does not have billionaires tax. They have lower tax rates. I'm going there like everybody else, like Jeff Bezos. This is what's happening. They're all shifting their wealth into Florida at this time. It's unfortunate, though, that the average person in California can't just fill out a form and say, hey, I've now shifted my primary residence to Florida, because they don't have houses all over the country like Zuckerberg. Okay, so here's a post here I got from BlackRock CEO Larry Fink. I do not believe there's an AI bubble by any imagination. Look, I don't know the man, never met him. This is not a slight against his personality. My rant is that, really? You believe this guy? I mean, it is BlackRock, and his job is to actually promote AI. So I would not necessarily believe that from that perspective. Oh, and to make matters worse, he's also the co-CEO of that World Economic Foundation, the WEF, that wants everybody to own nothing and be happy. And they meet behind closed doors to try and get more techno-government control. And not a good situation overall. So I'm not sure. Obviously, AI would help that. So I'm not sure that I would be listening to this guy who's talking his book and his objectives versus being more objective. Okay, my next rant. Rant 3. This is Poland here, one of the few smart countries left in Europe. So they're part of the EU, but they're considering becoming part of the Eurozone. They're cooling off on it. I wonder why. The EU, the Eurozone, is falling apart. There's all sorts of problems taking place. In North America, we don't see it. The media doesn't talk about it. They're coming out of all sorts of financial constraints. Poland has been booming. Why? Because it's not part of the Eurozone. So its own currency is being used, so it can adjust up and down from a monetary standpoint with production and its own economy. That's not the case in the Eurozone. It's got a huge fatal flaw, and this is causing huge problems overall. In fact, just today, the leader of the European Union, von der Leyen, said, well, she wants to move forward with a Euro bond, okay, with even if it means just 9 countries. Okay, they're doubling down. They just want more and more and more power. And this is really what it comes down to. Merz, I was surprised, from Germany, and no kidding. I mean, he came out and said, Germany is not going to be supporting it. Really? I wonder why, because it really would be a German bond supporting the other countries. So we're seeing a lot of problems in the Eurozone right now. And in this case, Poland would be wise to not become part of the Eurozone. Okay, my next rant. If we take a look at what's happening here, BMW's at it again. They want to charge for subscriptions to heat your seat in the winter in their cars. Your car, actually, you own it. The heater's already there, but they want to charge you to have access to it. Now, this subscription model is getting a little bit ridiculous. If we go back, Tesla has used it in the past to say, well, if we're going to start to limit your mileage on a go-forward basis, because that's what we have to do. We have to just make one battery system or whatever it is, and we're going to put a limiter on it because it's cheaper to manufacture. And this is a little bit different. I still don't agree with that necessarily, but this is a little bit different because this is a basic thing that all cars have pretty well today. And BMW wants a subscription. They want that ongoing revenue. I think it's ridiculous for some basic necessity to be able to say, we're going to charge you for that in your own car. And we're going to see more and more of this where they want more and more subscriptions for ongoing revenue. In other words, they just want you to rent more and more. So in other words, you don't own it, just at least rent it, have a warm butt. Anyway, I disagree with it. If you can, if you're tossing up between 2 cars, try and avoid cars that have those subscriptions if possible. Okay, if we take a look here, I got another rant here on Scotland becoming unlivable. Okay, full disclaimer, I used to live in Scotland when I was a wee lad. And I love Scotland. I love the people. It's gotten kind of crazy, if you take a look at what's happening to Scotland now. So here's this. I'm not going to go through all the numbers here, but they have a huge tax when you buy property. When I say huge, we're talking about 12% tax to buy the property. So we're talking big numbers here. These aren't like, 5%, 0.5% or something. Huge, huge tax. Then you've got a huge tax when you sell. Okay, so there's another tax. You have a huge tax when it's your holiday home. So you pay an extra tax. These are incremental taxes. Okay, so they'll negate each other. Huge tax if you rent. Yeah, okay. So there's another one. And now they've just introduced another one. A huge tax if your house is big. okay, this is getting ridiculous. The government needs to stop doing this. They're just taxing, trying to bleed people dry. They just need to find ways to cut back their spending and not try and bleed people dry. Anyhow, thank you very much for joining me today. If you like this video, please click the like button and please consider subscribing to the channel. Thank you.